without further ado, let's get started with part one, the PivotBoss Method Overview, Auction Market Theory, with Frank Ochoa, aka PivotBoss. Here's the PivotBoss Method Overview. And what's important about the overview is just to give you a visual idea of what the PivotBoss Method is. And if I have to kind of say what the PivotBoss Method is, it's basically a multifaceted approach that blends auction market theory with price and volume-based analysis in order to analyze and engage any market in any time frame using pro-style execution techniques. And the simple way around it is basically we're combining theory, analysis, and execution into one approach. This auction market theory portion basically gives us our trading plan as traders, as market participants. It gives us our plan of action. It gives us our roles in the market, whether we're responsive buyers or initiative sellers. It gives us ideas about who's influencing price at major turning points. It gives us what we need to know about price, about value, and how to see trade opportunities based off of those key metrics. So this theory is going to be very important, and it's going to set us up for how we analyze and execute the rest of the way. So that's going to be part one of the course. The analysis portion of the PivotBoss method basically gives you all the various ways to analyze the market and how. So price-based analysis and volume-based analysis, that's very important. There's certain ways to view price, there's certain ways to view volume, and how to analyze those things to give you the best outcomes for both analyzing and trading any chart. You also have to know how to watch the key intraday metrics. The intraday analysis is going to be very important, from the midpoint of the day to volume-weighted average price to the previous session's high-low close to the current day's open. Those types of things are very important. To using the footprint, all of those things are very, very important. Key range analysis, PivotBoss pivots, price-based signals, ADR method targets, those are all ways to view and analyze any chart in any time frame using price and volume as the major inputs. So that's how we're going to analyze the market. And then execution, that all comes down to entry techniques and trade management techniques. How do you get in the market and how do you get out of the market? So once you have your theory on how you think price will proceed, you've analyzed the market, you have a bias that tells you price is either going up or down. Now it's time to execute your bias, and that's where we'll get into the entry techniques and the trade management techniques. So this is going to be fun as we move forward. So now let's go ahead and get started with the theory here. This is auction market theory. And what I've done is I've put together just a few slides, just 3 slides on auction market theory here that you can use. You can print these out. I'll put them up on the dashboard. You can print these out, put them above your desk. So when you're trading, you're always looking at this information and you're trying to connect the dots with the words on this screen and the price movement on the chart. Connect the dots of what's happening in the market. Get into the mind of the market participants so that you know what's happening with price coming up. So with auction market theory, this is the theory that tells us how to engage a market as a market participant. So auction market theory is used to study how market participants act in an auction, including studying market efficiency, inefficiency, and optimal bidding strategies. So that's a very powerful statement in and of itself that really sums up what auction market theory is. And it's basically, auction market theory contains the type of market participants in an auction. We'll talk about the types of market participants here in the next slide. It also talks about the actual auction process. The auction process. What is the actual auction process? That's what you see here as well. And then I'll give you more about what price and value means with regards to auction market theory. So when we're breaking this down with auction process, the auction process can be described by this circular flow chart, right? And this circular flow chart basically has auction process here. Here is balance. And whenever you have balance, That's fair trade among buyers and sellers, right? Fair trade. You have a balanced market. Well, eventually, from balance, you get expansion. Expansion is caused by excess. Excess supply or demand leads to expansion. Once you're in an expansion phase, that's a price discovery phase. A price discovery phase is an imbalance phase. An imbalance phase is an elongated profile where price is seeking higher or lower levels. And from there, once it finds an acceptable area to do trade, it will create value. It will create value where volume is now traded in higher levels between buyers and sellers, and that creates balance. And then from there, you see excess, imbalance, value. You see the roundabout a way of going through things, right? So basically, this flow chart here gives you a great idea of how the market transitions between value and balance to excess and imbalance. And then again, how the process is recreated. So we'll see this in charts as well. So if we bring up a quick chart here, say, so first you see balance. You see balance established, right? And that's going to be important because when you see balance created, you see a trading range that creates. That's balance. A trading range is balance. And from that balance, you should find an HVM that develops from there, right? That's value. So once you create balance and value there, you're going to stay within that range because there's two-sided trade. The reason price is happy trading in this range is because buyers and sellers both can do business in this range. They're happy. That's what you see a trading range. When price comes down here, buyers can buy it. And then when price comes up here, sellers sell it. And then new sellers sell up here so they can bring it down and sell it to buyers that want to buy cheap and bring it back up. And you see that pattern go all over and over again. Okay? Now, eventually you're going to see excess supply or excess demand. In this case, we have excess supply. Excess supply. So that means there's too much supply. There's too many sellers. And now price must auction lower in order to entice buyers to defend. Right? And so now you're going from a balanced phase to an excess and imbalance phase. So right now, this is imbalance. This is an imbalanced price discovery phase where price is looking for new value, looking for new value. Eventually, it'll either create new value or it'll find a rejection point and bounce back to previous value. So that's basically the auction process. Now we have 5 key tenets of auction market theory. These are very important tenets here. The market is in auction. Okay, that's very important to understand. And I know some of you may have seen this information before, some of you may not. You know, this information is never going to change. I mean, this is just what the market is. So this information is something that you can write to your long-term memory and study as you go. Because if once you know these types of things, know the key tenets of the auction market, then you will know as soon as the market is doing a certain thing, you can say automatically that thing means that this will likely happen as a result, right? So you can begin to forecast where price could go. It doesn't always mean that will happen. It just means that's the most likely outcome or likelihood of that thing that occurred. So if it doesn't happen, that's telling you something else about the market. So you have to be able to analyze these things and have these bits of information right at the forefront of your mind. Number one is the market is in auction and operates solely to facilitate trade between buyers and sellers. That tells you that the market is an auction, open auction, where you have bidders and offerers. The bidders are trying to bid low or force or outbid and become aggressive and bid higher to force price to go up. So that means you're going to have different types of buyers and sellers. But basically, you're trying to satiate the demand and supply of those buyers and sellers. So you bring them to a market where they can settle it out, create value, and exchange hands and create volume, right? So the market is in auction. That's important to know. A lot of people don't understand that the market is in auction, and all you do is submit market orders and get huge slippage and bad fills. Instead, you should negotiate your pricing using limit orders at all costs is important. Number 2, price is used as a tool to advertise value. Price is used as a tool to advertise value. So price is just a way of advertising to the market, right? That's all it is. So if we go back to this example here, all right, so number 2, price is used as a tool to advertise value, right? What happens when you go to the store? Okay, say the holidays are over, January 1st has come and gone, and now you go to the store and there's a holiday section in the store. What have they done with the pricing of those products? It's put on significant discount, on sale. They're using price as a tool to advertise value. So say this is the holidays right here, and these products are priced within this price range. You know, say the products are priced between $50 and $100 for these products, right? And that's what it is. Well, now those same products, after the holidays are over, what has to happen is the stores are then going to mark those products down, because now there's no longer a demand for those products because it's no longer the holidays. So in order to entice buyers to get off their couch, to come off their wallet, they have to drop price down. The farther they drop price, the more enticing it is for buyers to come in and buy. So that's all that's happening. The market is used, or the price is used as a tool to advertise value. So when price is auctioning lower, it's auctioning lower in order to entice buyers to enter the market. That's how you know that there's more downside likely ahead for crude oil, because it's been going down, but not enough to get big time buyers to come in and defend. The last time that happened was in August. We got a significant rally. They tried to hold it and they failed. And when they did, we've been in a downside price discovery phase ever since. So you have to know that when price is going up, is to entice sellers to sell, right? So when price is going up, it's to entice sellers to sell their inventory so that buyers can satiate their demand, okay? So those are a couple of principles right there. Now let's go back to the slide here. And here's the slide. And now what we're looking at here is price auctions, number 3. Number 3, price auctions higher to motivate sellers, supply, and auctions lower to motivate buyers, demand. Okay, so that's what we just talked about. So this is a tool to advertise value. So when price goes down, it's to motivate buyers. When price goes up, it's to motivate sellers. Okay, so you got to know that. Number 4, price auctions higher until the last buyer has bought, and auctions lower until the last seller has sold. Remember, price auctions up to motivate sellers, right? Sellers. So it goes higher until the last buyer has bought. So when it goes up and the last buyer has bought, now there's no buyers that want to buy. Price has to come down to entice buyers to come back into the market. That's what's happening. And then lastly, value is established when buyers and sellers find an agreeable price, which leads to more volume being traded at that price level. So value is established with time and volume. When you have enough volume being traded over a certain amount of time, you create value, and that creates balance. So that's when this part of the phase is done, value and balance. But after you see value and balance occur, that's when you see excess and imbalance start to come in. And that's where you see expansion and movement toward new prices. So this is a fantastic intro to the major points of auction market theory. Now, we have to understand which market participants we are in the auction. That's very important. So this next slide here is about the participants in the auction. So auction market theory tells us what we should believe about price and value, and what we should believe about the auction process. Now it also tells us the types of participants in the auction. So auction market theory identifies several types of market participants. You must be able to understand your role in the auction in order to identify when to bid with the bidders and offer with the offerers. That tells you you have to know the roles. You have to know the roles of the auction participants to know which role you're going to be at the right times. And there are 4 roles in 2 categories. So auction participants can be split into 4 types of bidding strategies with 2 distinctive categories. Number 1, you have initiative participants, and number 2, you have responsive participants. I'll start with responsive first. Responsive participants are those that respond to price movement, price fluctuations. So those are the ones looking for the sale rack. When prices drop below and the store drops prices down from their regular listed prices, you have people that come in to shop for value. You got folks that come in to shop the sale rack. That's a responsive buyer. A responsive buyer waits for price to come to them before saying, you know what, that's oversold, that's undervalued, I'm going to defend that and buy it. Okay? So a responsive buyer buys below value and returns price to value. So you're betting that price is below value and that price will return to value. A responsive seller is the opposite. Responsive seller sells above value, looking to return it to value, betting that price will return to value, right? So those are responsive participants. When price gets too high, sellers come in and try to push it back. If price gets too low, buyers come in and try to push it out back to value. Initiative participants, those are aggressive buyers and sellers that seek to influence price movement. So they try to push price to new value. They try to seek price expansion from key balanced ranges. So an initiative buyer will buy above value, betting that price will seek higher value. An initiative seller will sell below value, betting that price will seek lower value. So if we take a look at, again, let's take a look here at the recent trading range right here. And if I bring up a profile, and we'll just put a profile together for this action right here. Okay, so this is value. This is above value, that's the value high, and this is below value, this is the value low. Okay, we'll learn more about this in the volume profiling and the volume-based analysis portion. But if this is value, a responsive buyer waits for price to get below value. That's below value. When price gets down there, now it's a bargain, and responsive buyers come in and defend that level and push it back to value. That's the pink line. There it is. You're done. That's the move. That's the move. Now when price gets to above value, responsive sellers come in and defend prices that are too high and return it to value. There it is. That's the move. It's done. So those are the 2 types of market participants under the responsive category. Those that when price gets too cheap or undervalued, as defined by the value areas, that's when they come in, defend, and return back to value, with a shot to seeing a move back to the opposite extreme, right? So there's 2 portions here. A responsive buyer will take it here and take it back to value, and then take it back to the top of value and finish the trade. A responsive seller will then pick it up here, return it to value, and then take it back to the bottom of the range and finish the trade. That's the circle of life for responsive sellers and buyers. Initiative buyers and sellers are different. An initiative buyer buys above value. So if this is value, they're not waiting for price to go on a discount. They're buying above value, anywhere here, betting that it will go here, right? They're betting above the top of value here and buying here, trying to get it to go here. They're aggressive, and they're buying above value because they're trying to influence price. The same thing with sellers. Sellers are selling below value. If this is value, they're selling down here rather than up here. An initiative seller is aggressive and tries to run the stops and seek further expansion. The initiative participants are usually the ones that are going to spark the massive expansion from key ranges like we've seen here. This was all initiative participants. So those are the types of participants. So you also have the OTF responsive participants. and that's right here, OTF responsive participants. Those are other time frame participants, and these participants have greater influence and effect on price. So an OTF responsive participant uses a higher time frame and has a bigger account than you. So think institutions, think wealthy billionaires, and all those folks. They're using higher time frames, and they're the ones that are, that have the massive limits to buy or sell at these areas that create iceberg orders that influence price. So OTF responsive participation influences reversals at the edge of major trading extremes, whereas OTF initiative participation triggers range extension from those balanced ranges. So in that crude oil example, we had this range initially. The OTF responsive participation is being seen at the edges of that range. And then once you see expansion from that range, this is OTF initiative participation that triggers the range expansion. So those are the participants. It's extremely important that you know these roles, and we'll talk more about them. You hear me say these words all the time. I'll be more conscious of speaking in these terms so that you can follow the conversation and know which is which. Now lastly, there's the principles of value within the auction market theory. And this is just the very end here. Basically, the auction participants must first identify value in order to discern when prices are undervalued or overvalued at a discount or premium, and then decide to trade from either a responsive or initiative standpoint depending on their opinion of value. So basically what we've talked about, we brought it full circle with this slide. We have the circular flow chart, right, which tells us which way to go, right? That tells you what phase the market is currently in. And then we have to identify where value is in the charts. And that's what we did earlier with crude oil when we were talking about where are the high volume nodes, where are the low volume nodes, where are the key ranges. That's all identifying value, identifying key price levels. And once you identify a bias, then we have to know, okay, which type of market participant am I going to be? Am I going to be one that's buying low or selling high, or am I going to be one that's selling high or selling low and buying high? That's all different, responsive or initiative. And again, these will all make more sense as we go forward. Now, when it comes to identifying value in the chart, this is extremely important because the market just moves based off value. If you can identify the various value levels and if they're going offered or bid, you have a very good idea of what the market's attempting to do and how good of a job it is doing at that job. So it's very important to know value. So here are a few of the rules for value. It is extremely important for traders to be able to identify value in multiple time frames. That's why you see me showing charts that have a 1-day value along with VPOC shifts, a 5-day value along with VPOC shifts, composite value in the daily time frame, and then micro-composite value. So you're seeing me deal with at least 4 types of value metrics across multiple time frames. And then I manage each of those valuations accordingly. If we're going offered in the lower time frame, that's an early indication that we're likely dropping to a lower HVN in the composite profile. If we're going bid on a higher time frame, that likely tells me that we're going to be bid in the lower time frames as well, or to defend pullbacks to lower values in lower time frames. Again, all of this will make more and more sense as we do it live in the room. Again, price is used as a tool to advertise value. We knew that from the previous slide. And value is the dominant variable in the markets, and it changes constantly. That's important. Value is the dominant variable in the markets. It's always changing. Value is always judged differently in all time frames. And it's up to you to be able to establish and identify value in multiple time frames so that you can get a better clue or picture of where price is headed. Now, price is also valued differently in each time frame. So, like we said, a 1-day value is going to have a different valuation than a higher time frame value, and so forth. So that's why you have to go in there, kind of see what the value is above and below the time frame that you're trading, so that you can have a better understanding of how you believe price may move about in the upcoming period of time. Historical value maintains significance in the future. That's important because we have to understand that value that occurred in the past can still hold its significance in the future if tested. That's why I went ahead and marked all the various HVNs in crude oil earlier above current price, because if price is going to move back to those key levels, we want to know about it. Demand drives value, and change in value reveals demand. So that's just something that you know, the mechanics of what's going on. Demand is going to drive value. Remember, if the market is bid, that means that buyers have big time demand, and price is likely going to drive up to entice sellers to sell. If there is no demand and the buyers don't want to come off their wallet right now, like in crude oil, then that's a change in value, and that's going to reveal a lack of demand, right? And that's why you're seeing the downside price move in crude oil. The market moves from rejection, unfair pricing, into acceptance, fair pricing, and then back to rejection. That's the normal flow of a market. So this is what a normal profile would look like with VPOC right at the center. This is rejection, low volume nodes. This is rejection, low volume node. And this is acceptance, high volume node. So the market will go from rejection back to value, and then back to rejection. And then from rejection back to value and back to rejection. That is the normal rhythm of the market. So knowing that is very important. So let's look at this really briefly here. All right, so here we are on this view. What's important here is that obviously we have those key value principles. Number one, price is used as a tool to advertise value, right? Number two, value is the dominant variable in the markets, and it changes constantly. So here's value, 49.13. That value comes from this key level, this key range. Then you have value at this HVN, and that comes from this minor range. And then you have value at 37.81, and that comes from this little range. The bigger the range, the more volume, the more value at that area. So if price finds rejection down here, the first value it's going to come test is this one. And if the bulls can wrestle value and maintain value here, it's likely going to go to this one. If they can do the same there, it's probably going to go to this one, right? But being able to understand value here, here, and here is very important, because down the road, it may not be for a while, but we're going to test one of these down the road, probably this one, at many months from now perhaps, or whenever that case may be. But this value will still maintain significance because traders are still holding from there. They're still trading from there. They still have, memories of their trades and what's going on and positions that have happened here. This is a happy point. So that's acceptance. So understanding value in that way is very important. And then when you drop down into a lower time frame here and look at something like this, where you have value now on a 1-day chart here, value on a 5-day chart, and then all the shifts that come along with it, it can seem daunting at first, but being able to piece all of these value levels together becomes much, much more easy as time goes on. Okay, so dropping back lastly into the last portion here is the auction market theory summary. Just really briefly, AMT provides the pathway for trading any auction. So what's important about auction market theory is one of those things that a lot of novice traders or even traders that have had some great times trading and have a lot of experience won't pay a lot of attention to for a long time, until it's too late oftentimes. But auction market theory is one of those things that true professionals, grizzled veterans that have been around since the 80s have really studied hard, because auction market theory presents itself in any auction in the entire world. So if you're talking about eBay auctions, if you're talking about livestock auctions, if you're talking about the auction that happens at your grocery market, these key things here all happen time and time again. These are recurring things that always happen. You're always going to see these fundamental principles work out in some way or another. So it's important to know and understand this like it's the back of your hand. It provides the pathway for trading any market because it gives you an idea of how to understand price and volume and value. It gives you an understanding of the auction process. It gives you an understanding of the type of participant you should be in the auction. And from there, it's all about just using your tools, your analysis, your trade management to get you in and out of these trades. Price auctions higher and lower in search of value for facilitation of trade between buyers and sellers. That's the number one thing to keep in mind right here, is price auctions higher and lower in search of value. In search of value, because remember, the number one reason that the market is around, the only reason why we have any markets, it's to facilitate trade between buyers and sellers. How do you facilitate trade between buyers and sellers? It's by finding a value area where buying and selling can occur. So if you break it down into simple concept, if you have buyers who want to buy, say, umbrellas because it's raining outside, well, you're going to have to buy umbrellas from someone who obviously has inventory and has priced it right. Okay? If it's raining and you have someone that's gouging you in a tourist city, and they say, I got umbrellas, but it's $50. That's not going to facilitate trade between buyers and sellers. If you have another store that says, hey, we got umbrellas and we actually have some on sale, that's going to facilitate more volume at that price, which creates value and facilitates trade between buyers and sellers. I hope that makes sense, because that is really all you need to know about markets in general, is that the markets want to create a trading range to trade and facilitate trade between buyers and sellers. They want to. Here's a great example of that concept. If I bring up the ES, you have to know that the market wants to trade in a range that facilitates trade between buyers and sellers. So here we are heading into December, and we know the December market is usually one that's not going to run off. There's lighter volume, lighter volatility, so it's not just going to run off, or it's not going to see huge selling pressure. It's not, it's going to be one of those markets where the market wants to define an area and trade within it. That range was created in early October with a big move here. You got this impulse move, and that sets the range now. So once this move happened, I remember at the time saying, watch price to drop back, because once it comes back, wherever that low is, that could begin the trading range that we could see heading into the end of the year, because the market wants to trade in that area to facilitate trade between buyers and sellers. Once that seasonality tendency was over, now we are free to move about the cabin, and that's where you see excess, you say price discovery, and imbalance. And then again, what is the market looking to do? At some point when the price discovery phase is over, you're going to see a bounce, and you're going to see the creation of a trading range where the market can conduct fair facilitation of trade between buyers and sellers. You have price trades with imbalance when buyers and sellers establish value, right? And then it has imbalance occurs when excess supply or demand enters the market. We've seen that. Price reestablishes value. Price reestablishes value and creates balance following an imbalance and price discovery phase. That's what we just talked about. So in the ES, we saw expansion from that end of year range, and we're in the price discovery phase. At some point, the market will reestablish value and establish a market here where we go back into value and balance, and then we're going to see another range of expansion after that, either up or down, right? So that's the way that markets behave. And lastly, knowing the cycles of the auction process and its participants gives you the knowledge required to have longevity as a trader in any market in which you wish to participate. And that is no lying statement. If you can just absorb these 3 slides and then visualize every portion, every bullet point, understand these like they're the back of your hand and be able to recite them if you need to, that will give you the understanding that you need to know to have the required knowledge to have that longevity in this career. Because traders that don't know these principles are doomed to give their accounts away. It may not happen now, it may not happen later, but at some point you're going to get bit because you don't understand these principles. So it's very important for you to understand them. I know I've gone over time here, but again, I get to talking and I'm not going to finish teaching until the teaching is done. And hopefully you all enjoyed part one of the executive training series. Again, this was part one, the PivotBoss Method overview, auction market theory. And it's really these concepts that I believe will set you up for all of the other analysis and training that will come in the rest of the week. Aside from this, obviously we have all of the various components of the PivotBoss method to look forward to. We just knocked out auction market theory right here. We'll put a nice check mark. The next one is going to be price-based analysis, and that's going to come to you tomorrow, followed by volume-based analysis. That's going to set the stage for how we view price and volume. And then from there, we're going to talk about intraday analysis, key range analysis, and the rest. So this is going to be a whole lot of fun as we move through the rest of the next couple of weeks and as we continue to wet our feet in the PivotBoss trading room. So with that, I want to say thank you all very much for attending the very first part one, the PivotBoss Method Overview, Auction Market Theory, which is part of the 10-part executive training series. And there's going to be more to come, and I'm looking forward to it.